Good morning to everyone. Today's focus is going to be on the British pound. We're looking at the 4 hour chart, and well, down on the 1 hour, you see we've got a big red candle that is a decline of around 0.4, 0.5 drop following the jobs disappointing UK jobs report. So GBP USD is currently trading around 135.85 down after, of course, having broken the previous support at 135.90, 135.94, or you might as well just call it the 136 because this candle really opened at 136.10. And this actually, guys, becomes a very important level. This is the high momentum candle to the downside. Only if we break back about that level can we really see markets recovering from this drop once again. It's going to largely depend on the CPI inflation data that coming out tomorrow. This is the first UK data, major UK economic data that we see this week. And we've also got, of course, the RSI here to take into account. Back on the 4 hour, and the catalyst for this move, of course, was clear. Unemployment rose to 5.2 versus 5.1. And average earnings, very important for the Bank of England monetary policy view, I would say, fell substantially to 4.2 from 4.4 or 6, if I'm not mistaken, with the per figure, of course, also revised downwards. So that reinforces the narrative of a weakening economy overtaking inflation risks. Remember that the BOE held rates in February with a narrow 5-4 vote, okay, because Andrew Bailey turned, neutral. So he currently holds the deciding vote, and the switch now from a hold to a cut is also increasing. If inflation data follows suit tomorrow, a March rate cut becomes highly probable. Now, the pair, we talked about these 5 wave legs to the downside for a while, and we said that we expect to see a correction taking place. And we were between the correction having ended here, and then we're going to move lower down, or the correction maybe is going to still end higher up, which means this is a corrective leg in the wave B. Typically, we would see this correcting indeed if it was the case, but not as deep as the current 78.6 correction. But either way, this is becoming a cluster over here because you've got the 78.6, you've got the lower channel of this downward trend, okay, and of course it's the 135.50 or so, which is a strong psychological support. Now, with that being said, let's not forget that we are seeing this RSI divergence being validated now, and our RSI on the 4 hour is still at 36, so there is room for further downside. Okay, and as I said before, in the 1 hour we see the RSI flashing oversold at 18. Okay, and if we look at it from a downward perspective, this also aligns with the 100 Fibonacci extension of that initial leg to the downside at 135.15. So we could indeed see this recovering higher. Okay, but my concern is here whether we see, which might be unlikely, the 136.11 being retested ahead of the CPI. I think a full recovery of this jobs report would only be possible following a hot CPI. Okay, that is my only concern. Now, as I said, if we do manage to move back above 136 and 136.11 or 10, and we maintain that level, there would be actually, the chances of moving higher are going to increase. And we'll be looking not just for the 137.38 golden Fibonacci, but also at the 137.56. But it's really dependent on the CPI tomorrow. If the CPI also comes out worse than expected or cool, okay, we'll have the bearish momentum continuing. Our next major target uh, outside of that range would be the 61.8 Fibonacci retracement, because it would suggest that we have ended actually this correction at wave C up here. We're looking at 134.95 and 133.58, which, by the way, is the 100 Fibonacci extension and comes very close to the January 18 low. So all eyes now turn to tomorrow's UK CPI inflation data. We're currently sitting at a make or break point for me. A bounce from this channel bottom is possible for now, but the medium-term direction hinges really on inflation. So if the CPI cools, confirming the job data signal, it will likely log in the next leg lower towards 133.50. So watch that 136, 136 10 resistance very closely. As long as we stay below that, the best remain in control. Manage your risk, and let's see what the CPI brings tomorrow.